This is the current federal tax developments for May 4th, 2026. Current federal tax developments are brought to you by your state society of CPAs. Today, we're going to be reviewing a number of recent administrative and legislative developments that affect federal tax practice. The courts were especially the tax court was rather silent this week. So we're not going to have much in the way of cases. We are going to have a lot of other things that went on this week. So, several updates we do have this week. We're going to discuss the parameters for reasonable cause relief under the small corporation provision for Form 5472 penalties that was discussed by the IRS in a document. We're also going to look at the new IRS procedures for extending the statute of limitations for disallowed employee retention credit claims, which are a problem because of a 2-year statute that for many people who've had a disallowed claim is about to run out. We're going to next review a comprehensive package of tax administration bills that were passed by the House. Again, they haven't gone through the Senate. We don't know if they'll make it through the Senate, but they did pass by a wide margin in the House. Caveat, we've had that happen before, and the Senate simply said, no, we're not doing it. So don't think these are given, but it's nice to know they're there and understand that they may pass. So we'll keep an eye on those. We're examining anticipated tax guidance following the rescheduling of medical marijuana. Treasury gave us kind of a roadmap of what they plan to do. We're going to analyze the new dyed fuels excise tax refund regulations under Section 6435, in case you're involved with that. And we're going to finish with a look at the new executive order concerning retirement savings and the interaction with Internal Revenue Code Section 6433, which is the credit for contributing to your retirement account if you are of low income. So we'll talk a little bit about that background. So our first development centers on Chief Counsel Advice 2026-17012 that was issued on April the 24th of this year. This memorandum from the Office of the Associate Chief Counsel International addresses administrative ambiguities by advising IRS personnel on how to evaluate a small corporation's claim for penalty relief under the small corporation provisions when they should have filed a 5472 that it turns out they didn't file. So if you're advising a foreign-owned domestic corporation, the stakes for compliance are pretty high in this area. Under IRC Section 6038 Cap A and B, any domestic corporation with at least 25% foreign ownership must file Form 5472 to report transactions with related parties and must maintain the appropriate records. Failing to do so triggers a mandatory and severe penalty. Under Section 6038 Cap A D1, a $25,000 penalty is imposed for each taxable year a failure incurs. And as you can guess, they may go for years not realizing they should have filed this form. So that $25,000 can start adding up over time. However, taxpayers may seek relief under a reasonable cause exception found in 6038 Cap A D3 and Treasury Regulation 1.6038 Cap A-4B. To obtain this reasonable cause relief requires affirmative showing of good faith made under penalties of perjury. Because these requirements can disproportionately burden smaller entities, that's a problem with a flat $25,000 penalty. If you're Walmart, it's kind of irrelevant. So I don't think they need to file this thing. But if you're a small, closely held company with revenues of, let's say, $900,000 and a net income of $75,000, $25,000 penalty starts adding up pretty quickly. So regulations include a small corporation provision, and under Treasury Regulation 1.638A-4B2II, the IRS is instructed to apply the reasonable cause exception liberally for small corporations. The question before us is, what does that mean? How is the IRS supposed to interpret this? Now, according to the Chief Counsel Advice 2026-17012, which is what we're talking about, before a taxpayer can benefit from this liberal application, they must establish 4 strict prerequisites in order to get this. The entity must have overall gross receipts of $20 million or less for the taxable year. The Chief Counsel clarifies that, unlike other exceptions under 6038 Cap A, this threshold measures global overall receipts, not just U.S. sourced receipts. So that's the global measurement issue. Right? You must show a lack of knowledge, and that is regarding the need to file this form. The IRS will heavily scrutinize historical compliance to test this assertion. This is kind of your fourth test kind of here. They will look at whether the taxpayer or any other entity, controlling entity, has previously filed a Form 5472 for any other entity. In essence, if you the owner, you've already filed them for multiple companies, the fact you didn't do it for this one suggests maybe it's not reasonable cause. So again, our two key tests on this slide, the gross receipts test, the lack of knowledge test, with clarifying points. Okay, continuing with these prerequisites that are outlined in the Chief Counsel advice, the third requirement is a taxpayer must establish a limited presence in and contact with the United States. The IRS evaluates this by looking at the location and experience of the corporate officers, the size and frequency of U.S. transactions, and the extent of interactions with domestic businesses and government entities. If you're a relatively large corporation with a lot of activity in the U.S., you're going to probably have a problem here if you regularly do lots of business there. That's like one of these things you should have figured out. If you're going to be operating heavily in a country, it's kind of nice to understand their tax law because they're probably going to tax you. So I'm just going to say that's how it goes. By the way, same thing's true of U.S. businesses that decide to start operating in a different country. Same issue. Fourth, once notified, the taxpayer must establish full and prompt compliance with the IRS request to file Form 5472 and provide relevant materials. The IRS will judge the quality of the response by looking at its timeliness, its completeness, and whether the IRS had to follow up multiple times to extract necessary details. So, yeah, did you promptly comply once the IRS pointed out the error of your ways, or did you ignore it, and only after the IRS went after you multiple times and start threatening things did you finally go ahead and, take care of this? That's a problem. Now, we're going to talk how the IRS defines, at least in the ideas of Chief Counsel advice, a liberal interpretation of reasonable cause under these rules. According to the advice, liberal bears directly on the level of scrutiny the IRS applies to the penalty relief request, meaning a small corporation relief request prerequisites make it easier to establish relief. In fact, with a qualifying sworn written statement, the IRS is ordinarily justified in granting relief without doing a deep investigation into the issue. However, practitioners must understand that even with this, the reg says liberal application, your release not automatic. The IRS will deny conclusatory submissions lacking factual backings. Oh, we meet all the four tests. That's not going to be good enough, right? Or statements that contradict known facts. Your lying is not a good thing if they can show you're lying. Finally, understand the effect of this relief. It extends the deadline to furnish information out of penalty, but it does not exclude the underlying requirement to file Form 5472 or maintain the required records. You still got to get that done. You don't get that done, that's going to kill your prompt compliance, which is going to clear your relief. So kind of important to get moving this way. As we've done in the past, recently, we do have our infographic that's in the slide, which illustrates in this case the financial stakes we have for noncompliance, which is we have a really, really major expensive fine. In essence, a 90-day for initial failure, there's a $25,000 initial fine. And then every 30 days after 90 days have passed since they impose the $25,000, you get another $25,000 fine. So this starts adding up quickly, right? You need to do that. Essentially. So we have to worry about that. And then we have the small corporation safety net, the SCCP is what they refer to it. It talks about the qualifications necessary, the 4 pillars to get to the liberal relief benefit, and how liberal relief is applied. Key issues there. So again, that infographic, it's on the screen if you're watching this on the video. It's also going to be in the slides if you go to the website on the video and audio, weekly update, and you just download the slides for this week, you'll get this information. Next up, we shift gears to the employee retention credit claim, something that we've been so thrilled about ever since they first came out. On April 27th, the IRS issued an Internal Revenue Notice, or Internal Revenue News Release, we'll call it, right? IR 2026-58, announcing a new option for certain taxpayers to request more time after an ERC claim disallowance. Basically, to extend the statute for filing lawsuits in a district court or the court of claims after the IRS has denied your claim for an ERC refund. Why this new guidance is so critical right now? There is a very strict statutory clock that I have found a lot of people don't understand. In essence, there's a key difference when we're talking about litigation that will be filed in U.S. District Court versus the standard IRS deficiency procedures, where they give you the 30-day letter. You then can ask for appeals, and if you do that, the 90 days to file with tax court doesn't run. But what does happen is the IRS is under pressure at that point because they're the one who are now going to ask for money that has to come within the statute. So generally, when we're in the IRS is going through deficiency procedures and trying to get money from us, we don't need to worry too much about the statute until the IRS has actually issued a 90-day letter. Then we have a statute in order to challenge in tax court and not have to pay immediately. We know all those things. When we're talking about an ERC denial, that ERC denial is not the equivalent of a 30-day letter, and that's what's going to be important here. Upon receiving the notice, right, if you received either a letter 105C for a full disallowance or letter 106C for a partial disallowance, from the date of receiving the notices, you have exactly 2 years from the date of that letter to either resolve the claim administratively or file a federal refund suit. And going to appeals does not stop the clock. The clock keeps running. That's important. You have to strongly caution your client when taking a protest to the Independent Office of Appeals that clock's not stopping, right? And it doesn't mean the IRS is going to get your appeals within 2 years. That's also important. You need a formal written extension, option 1, or you need to file the lawsuit with U.S. District Court, U.S. Court of Federal Claims within that time window. If you do not, the IRS is prohibited by law from paying you the money, even if appeals admits you qualified for it. You have to get something done by 2 years after the date that you have filed, that you were told 2 years after they issued the letter, I say, denying your claim for refund. That's going to be issued, right? So keep that in mind. If that 2-year clock runs out, everything's gone. This isn't quite like, all the collections alternatives you have, right? Where even though you're supposed to pay this money, you have ways you can try to work around it, audit reconsideration, et cetera, et cetera. No. IRS owes you money and they're legally told absolutely you can't pay it. Because the taxpayer blew the statute. So this is an important deadline not to miss, and not necessarily the easiest thing to get extended. So to address this ticking clock, which basically has been addressed by the National Taxpayer Advocate as a major problem because taxpayers are having real trouble getting the IRS to actually respond to anything about many of these notices. They have a new streamlined administrative fix that was introduced in the news release 2020-658. The option is designed specifically for taxpayer approaching the end of their 2-year window to help them avoid a premature refund litigation. I love the IRS puts that way. They don't want you filing suit. They understand what happens. But everybody, you better be ready to file suit. You better have considered, because it might not pay. It might not be worth it to file suit. But you better have had that discussion with a client. If that client thinks their $50,000 ERC credit is going to be kept open until appeals, finally hears their case, not unless you get an extension of the statute. And since the IRS doesn't have to extend the statute, you need to be having a conversation with that client about at $50,000, it's probably not worth litigating in district court because the legal fees could run up for a vast majority of that easily. So you got to understand, what are we going to do? And we probably are going to try to get administrative extension. And that means we've got to start moving on it as soon as we're allowed to do so, or at least as soon as this program allows us to do so. But we have to talk. If that clock runs out, client, you better have talked with an attorney about what the cost would be to take your claim, up the line and make a decision whether you're going forward or not. We need to strategize on whether this is something we want to pursue, because we got to get a serious answer to your chances of carrying the matter. Now, to be eligible for the streamlined extension, you have to meet two strict criteria. Okay. First, you must currently be waiting for the IRS to review the response to a letter 105C or 106C, basically the notice of disallowance. Secondly, they must have 6 months or less remaining before the 2-year statute runs out. That's going to be crucial for you. Make sure you understand your statute. So if the statute if the statute's going to run out, once you get to that 6 months out date, I'm going to tell you want to start this process, because I'll point out a couple of problems with this process that we'll get to. Okay. The IRS is actively supposed to be sending a notice CP 320B to taxpayers they identify as eligible. But you can and should act proactively, because taxpayers may be eligible even if the IRS has not, sent them this notice, or frankly, the client may never have opened the notice. So check your clients who have ERC refunds that have been ERC claims, have been denied, and who are trying to contact the IRS to get them to reconsider, either through appeals or some other process. We need to get things going because appeals is backed up as heck. And this will be an easy way to clean out appeals, because these things just going to fall off the end of the world, and those cases will be resolved by the simple fact of the statute. That's important to understand. To utilize this extension process for the ERC, you must file Form 907, the agreement to extend the time to bring suit. Under these new procedures, representatives can submit Form 907 using the IRS document upload tool by visiting irs.gov/DUT reply and selecting notice CP 320B. That's going to be your key issue to get there, right? However, there's a huge exception. If your client already has requested an appeal and you know your assigned appeals officer, you must instead contact that officer directly to request the extension rather than using the document upload tool. So if you've been assigned one, you got to get their attention. That may be fun, but you need to do that in order to get down this. Finally, it's crucial to warn your clients that submitting the form does not immediately stop the clock. The extension is not valid until the IRS formally countersigns and returns a copy to the taxpayer or their representative. So if the 2-year date, if you file today, you're 6 months out, and the 6-month clock starts running down and you're sitting there with 2 days left, clients got to have things ready to go to file that case in district court, or recognize they're simply going to lose the ability to pursue this. Nothing in this news release guarantees the IRS will act on this thing. Not only does it not guarantee you'll get it, that they're going to approve it, but they don't even guarantee they're going to even consider it. They might just not get to it, in which case then you're back to you got to file suit. So I always think this news release is more important what it didn't say than what it did. Okay. Now, when preparing the form, this is crucial. Precision is absolutely mandatory. If you fail to complete required fields like the exact period ended or amount of tax, that can result in a delay or denial. And remember, delay can kick you past the 6 months on its own, right? You must submit a mandatory statement detailing the factual and statutory issues involved in the refund claim alongside the form. So if you just haven't bothered anything, or you think somebody's taking care of it, you haven't yet actually worked the case, you're waiting for appeals to contact you, before you're going to actually do some work, you better start doing some work on the case. Figure out where you're at. When drafting these statements, you must be hyper aware of the underlying statutory deadlines. For instance, the IRS may disallow a claim on untimeliness grounds by citing specific statutory mandates, such as Section 70605D of Public Law 119-21, known as the One Beautiful Bill Act, which established strict filing deadlines for certain 2021 quarters. If you are acting at your filing as representative, you must also remember to include a copy of your signed Form 2848 power of attorney and declaration of representative, especially ensuring that line 5A is completed to authorize your signature on the 907. You have to be able to be authorized to sign a 907. If you're not, again, at best, you've got a delay. At worst, that delay is going to push you past 6 months. So, yeah, definitely don't want to blow this. As I said, the problem is no guarantee that they're going to get to this and grant you this extension by the end of 6 months. All they're giving you is a way to highlight this, which frankly is better than nothing. But you read this thing, there's no guarantee anywhere in it that you're going to get an extension, or you're even going to be told they've denied it because they looked at it and decided you didn't qualify. They weren't going to do it. They don't do it, you don't get it, and they are prohibited by law from issuing a refund. We're done. You can't let that go, or at least the client's got to understand the issues, right? That's why you need to have a discussion about the cost of filing a lawsuit, which does mean you probably should get an attorney involved here. Right, we're going to pay for an hour, 2 hours for the attorney to discuss the basics here of how much money you'd be looking at having to come up with in order to litigate this thing. And, and a worst case theory as well. I mean, yes, we'd love to think we filed the lawsuit, the IRS then, contacts and a settlement's negotiated and we're done. That'd be nice, but it might not happen. So you have to understand how much money you're committed to if this thing has to go all the way to trial. So understand that background. So again, we have this nice little infographic called Protect Your ERC Refund, extended to your deadline. The left side of it actually talks entirely about the 2-year clock. You got to explain the 2-year clock to your client. You have to understand the 2-year clock. Claims for refunds are different than when we are talking about, having a deficiency procedure where the IRS is coming after you for money. When you're asking them for money, you are the one that has to watch the statutes. They're asking you for money. Initially, they got to watch the statutes. That's a big difference. And then the extension process with Form 907, right? You can do the streamlined digital submission either through the portal if you haven't been assigned an appeals officer, or if you've assigned it, you got to contact that appeals officer. It's also why we want to start early in a 6-month period and get the 907 to them. But remember, until the IRS countersigns the 907 and returns that to you, you don't have an extension of the statute. That's why you've got to have had the conversation of what do we do if time's running out? Are you going to get a filing in court? Are you going to have the counsel get the attorney to file in court? By the way, yeah, you do. First thing is, obviously, you as a CPA or EA, if you're not an attorney, not a member of the bar, you cannot represent clients before U.S. District Court, the Court of Federal Claims. Number 2, I really don't think this is a good do-it-yourself project for the client to go try to represent themselves in these courts. Just saying. So you want to get an attorney involved and, get the client to understand the real-world costs of pursuing this. Is it fair? Maybe not. Is it the law? Definitely. So keep that in mind. Next on, Congress actually did something this week. We have the House passes comprehensive tax administration and relief bills, right? And this was done via floor action on April the 27th, 2026. Now, in this case, there was a suite of 9 bipartisan tax administration bills that were all passed by not quite unanimous, but very close unanimous votes. So in essence, votes from both parties. They were adopted using they were basically advanced using a fast track procedure, not adopted because we still haven't, still not been approved by the Senate, using a fast track procedure generally reserved for non-controversial legislation, which these 9 are meant to be. While they received overwhelming support in the House, their future in the Senate is currently uncertain, as Senate tax writers introduce their own broader tax administration package, which is Senate Bill 3931, in essence, which hasn't gone anywhere yet in the Senate. But we are going to review these key provisions of several of these newly passed House bills, just so you understand what's in play. Okay. So our first thing we want to look at is advancing procedurals and administrative protections. These are 2 bills we're going to look at here. H.R. 6495, the Taxpayer Notification and Privacy Act, introduces stringent requirements for IRS third-party contact notices. It amends IRC Section 7602C1 to enforce a 45-day lead time, requiring the IRS to give taxpayers at least 45 days to respond to inquiries independently before the service is allowed to contact third parties. It also mandates that the notice specifically identifies each item of information the IRS intends to seek from that third party. Next up is H.R. 227, the Clergy Act. This bill provides a unique window for members of the clergy by amending the code to allow them to formally revoke their previously granted exemptions from Social Security coverage. You ever had that a young minister, elects to opt out of Social Security coverage? Fine. They end up not having to pay in, but then as they get older, they discover that, well, they didn't have to pay in, but not get anything if they didn't. So now they're in trouble. So in essence, this operates notwithstanding Section 1402E4, allowing revocations of exemptions under Section 1402E1, provided the application is filed no later than the due date of the return for the applicant's second taxable year ending after December 1st, 2028. In essence, you're going to have effectively up through the end of 2029, or 2030, I should say, to make this one-time "I didn't mean it" statement and come back in under Social Security if this passes. If you have pastors who have opted out of Social Security, and they now have buyer's remorse, you want to keep an eye on this bill. They can get back in. And, we'll worry more about what finally appears as to what the conditions are and what exactly is going to happen with them given their other earnings, and whether or not, how big a difference it'll make. But you are going to have a time limit to get this in, at least if the bill passes without any changes. Now, there are a number of business relief and automation legislation items, right? Let's talk about these where we're going to have these. H.R. 6431, the New Opportunities for Business Ownership and Self-Sufficiency Act, that amends Internal Revenue Code sections 3306T3 to remove the requirement that taxpayers participating in self-employment assistance programs must prove they are likely to exhaust regular state unemployment benefits. Currently, to help you set up your business, if you're in unemployment, you have to show that you're going to exhaust your state unemployment benefits before they'll give you this money. Now you don't have to do that. Well, I should say if it passed. Again, none of these have passed. H.R. 2347, the Survivor Justice Tax Prevention Act, that amends Section 104A2 to explicitly exclude settlement income related to sexual assault or contact, removing the burden for victims to prove visible physical injuries to qualify for the exclusion. Remember, under 104, generally, you've got to have physical injuries and prove physical injuries, right? There are a couple of other add-ins here that make it much easier to handle, this kind of exclusion. So again, could be big if you have clients that have received settlement or are in the process of negotiating settlements, right? For essentially for sexual assault or unwanted contact. H.R. 5366, the Doug LaMalfa Federal Disaster Tax Relief Certainty Act. It amends Section 165H to permit non-itemizers to claim their disaster-related personal casualty losses as a standard deduction addition under Section 63B. In essence, it's going to just be an additional standard deduction like the non-itemizer's charitable contribution we're going to qualify for here in 26. So that would go there. Again, remember, none of these are law yet, so just keep an eye on them. Finally, H.R. 6956, the Barcode Efficiency Act, would force the IRS to modernize by mandating any electronically prepared tax return filed on paper must bear a scanning code and requires the IRS to utilize optical character recognition technology to process them. Now, the IRS theory of this has always been, no, we want everybody to e-file, right? But this be clients who paper file, they would have to have a way of processing those paper filed returns that would utilize the barcodes and OCR technology. Again, not the law yet. We have to wait. Then we have basically two more bills that cover taxpayer experience and deduction, right? So in this case, we have House Resolution 5334, the Supporting Early Childhood Educators Deduction, or SEED Act. The bill amends Section 62D1A, which is the deduction for classroom teachers, to expand $250 above-the-line educator expense deduction, replacing a kindergarten through grade 12 teacher with an early childhood or kindergarten through grade 12 teacher, effectively extending the deduction to those who teach pre-K, toddlers, etc. It'll be there, right? And next, we have House Resolution 7971, the Taxpayer Experience Improvement Act. To improve IRS customer service, the bill mandates that a real-time public dashboard displaying the number of callers connected, the number waiting, and the longest wait time be put online by the IRS. It also mandates a digital access overhaul, requiring the IRS to provide fully functional online accounts where professionals and taxpayers can view returns and notices and transmit responses directly. Finally, it forces the implementation of a taxpayer callback option for calls not answered within 5 minutes, which is slated for implementation by 2028, if the bill passes. All of which would seem like nice additions if you've ever had to call the IRS. You know how that works. We've all been on there. We've all been there. We've all had courtesy disconnects. Yeah, we all know the whole thing there. Okay. The final bill to highlight is H.R. 7959, the IRS Whistleblower Program Improvement Act. This legislation targets severe administrative delays as whistleblowers currently wait an average of 11 years. It's not 11 months, it's 11 years for their rewards. To strengthen protections and expedite the process, the bill amends Section 7623B to ensure the tax court reviews of whistleblower claims are conducted de novo, based on administrative records and any newly discovered evidence. That means the court starts from scratch. They don't they don't evaluate solely on whether the IRS abused their discretion. The court itself reviews the case and makes their own decision about whether a whistleblower award is justified. In essence, they don't defer to the IRS unless the IRS, abuse their discretion. It adds Section 7623B6D to grant whistleblowers the explicit right to proceed anonymously before the tax court, absent of finding that the societal interest overrides the risk of harm. In that case. Then furthermore, it adds a new Section 7623B7 to levy interest and penalties, against the IRS at the overpayment rate under 6621A if the agency fails to provide a preliminary award recommendation within a 12-month period. Now, unfortunately, I expect the IRS will probably have an initial recommendation of not by the end of the 12-month period now, but Congress goes so far. We'll go with that. Again, we have our infographic here going over all 9 of these bills. You can get those. Obviously, we have them, in here grouped by the way we talked about them: taxpayer service and transparency, operational efficiency and protections, and tax targeted relief and assistance. So we've got that. A couple of other things there going on. So, some basic things there. We'll look at that. I think one we didn't talk about was the HR, in this case, 5366. And that would excludes wildfire relief payments from a taxpayer's gross income. I think that one was omitted from the slides accidentally, but it's here, right? It's in the infographic. So we have that. Next up, we're going to shift to administrative developments. And today, we're introducing this one called Anticipated IRS Guidance Following the Rescheduling of Medical Marijuana, which is a U.S. Treasury website that was published on April the 23rd. So this is the anticipated tax guidance following the Department of Justice and Drug Enforcement Administration final order rescheduling certain medical marijuana products that we discussed last week. On April 23rd, U.S. Treasury and IRS issued this press release outlining the process for forthcoming tax guidance in response to the administrative shift of the DEA. Right. Now, again, to remind you, why is this critical for tax practitioners? We're advising clients in cannabis. Historically, state-licensed cannabis businesses have been subject to the strict deduction disallowance of Section 280 Cap E, which bars most deductions or credits for businesses trafficking in Schedule 1 or 2 controlled substances. The only deduction allowed is for cost of sales for those Schedule 1 or Schedule 2 controlled substances, and marijuana is at least was, for all purposes, a Schedule 1 substance. Because the Department of Justice final order removes FDA-approved marijuana products and marijuana subject to qualifying state-issued medical license from Schedule 1 to Schedule 3, that dissolves the statutory bar under 280E, the deductions, for these specific operations. Now, again, remember, it is only for medical marijuana. It is not for recreational or adult use marijuana. That's not there. The Treasury confirmed their April 2026 release that this rescheduling effectively removes the restriction that have historically barred all deductions except cost of goods sold for these businesses, as long as you're compliant medical operations, right? The IRS expects to generate significant positive tax consequences for the medical marijuana industry after this change. So we're going to tell you. Now, we don't have the guidance yet, but we're going to be told what that guidance is, at least somewhat that guidance is going to tell us, right? Now, the transition will not be entirely straightforward for businesses that have mixed activities. Department of Justice order leaves unlicensed marijuana crops such as bulk marijuana and non-FDA approved extracts classified as Schedule 1, along with adult use. Consequently, a lot of enterprises will end up running dual simultaneous operations, some of which is dealing with medical marijuana and some of which is dealing with the other, still Schedule 1 marijuana, right? And that Schedule 1 marijuana remains subject to 280 Cap E. And they also, have to deal with these things that are in and exempt. Treasury plans to issue complex cost accounting regulations effectively clarify how taxpayers must apportion expenses between these activities. You got to divide them in two. You're going to have methods you can use to do that. That's going to be issued. The practitioners will need to move beyond traditional cost of goods sold reliance under Section 471 and prepare robust segregation methodology, get the word out, for allocating overhead, rent, payroll, etc. between Schedule 1 and Schedule 3 revenue streams. Again, for the Schedule 1 stream, those will be deductible. For the Schedule 3 stream, 280 Cap B still bars them. Now, yes, I realize that the Department of Justice has indicated they're still studying the other ones, and they might move them to Schedule 3 too, but they haven't done that yet. So for right now, all we know is the medical side of this, right over there. Now, the IRS did put out a generally taxpayer-friendly transition rule, but maybe not as friendly as Department of Justice suggested they should do, right? To simplify compliance, the Treasury's expected guidance will provide the removal of 280 Cap E penalty will be considered to first apply for a business's entire full taxable year that includes the effective date of the final order on April 22nd, I think it was, of 26. That means if you're a calendar year medical marijuana only business, right? The only thing you do is covered by this order, then 280 Cap E will not apply to you if you're filing a 2026 calendar year return. That's kind of useful, right? You're not forced to arbitrarily cut off and bifurcate 2022 tax on April 22nd, with everything before that date being disallowed and everything after that date being allowed. You'll be able to take the whole year as long as you don't have any other operations of a Schedule C, a Schedule 3, a Schedule 1 variety. Get the right name in there. If you have that, then you're still going to be doing some weird allocations, so we're not there. So, but if you are medical, you'll be totally free from 280 Cap E restrictions for the entirety of the tax year in which the order takes effect. If you're a fiscal year, you look for the fiscal year. If your fiscal year was April 30th, then you won big. Because while for almost all of your fiscal year, your marijuana was a Schedule 1 item, because it ceased to be on the 22nd of April, you'll be able, let's say you're a C Corp, you'll be able to file that April 30 fiscal year, April 30, 26 fiscal year return, and you won't have to worry about, going and disallowing any of the 280 Cap E stuff. It's kind of useful, right? In there. Okay. Now, here's the problem. The Department of Justice was saying, hey, IRS, we encourage you to offer retroactive relief, right? So in its final rule, the DEA explicitly encourages the Secretary of the Treasury to provide retrospective relief from 280 Cap E liability for prior taxable years in which the state licensees operated compliant medical facilities. No. Despite this prompting, the press release is completely silent on any retrospective relief, maintaining a strictly prospective stance. What is important here is Treasury knew about that statement and elected to say nothing. They didn't say they won't, but they didn't say they will. And I think the problem is the Treasury is not sure they have the authority, right? This is black letter law. And does Treasury have the authority to override that law? which is kind of what DOJ is asking them to do. Pretty pleased, because it would be awkward trying to get Congress to approve this. I wouldn't bet you're going to get retroactive relief. I'm just going to say it that way, right? But we'll see. But obviously, I think there's going to be some discussions between the Attorney General, whoever that may be, by the time we finally get to this, right? We don't know who's going to be appointed to be the permanent Attorney General, and the Treasury Secretary, Secretary Bessent. There'll probably be discussions about whether Treasury can and cannot do that, and the attorneys that work under both of them, right? This is the IRS traditional strict statutory interpretation because the substances were legally classified as Schedule 1 prior to April 2026. The statute requirements for the 280E disallowance were met during those years. The immediate action item for tax professionals is clear. You don't want to prepare amended prior year's return containing retroactive forgiveness unless Treasury authorizes you to do so, but you might want to prepare protective claims, indicating you're solely filing this because of what was in the DEA, final rule, and the fact that Treasury has yet to comment on whether they plan to offer such relief. So if they do, I want to keep the year open. But if they don't, we're not actually filing a claim, because you can get into problems with the IRS ruling that claim is frivolous. You try to qualify right now, because there arguably is no authority, because DEA even admitted that they don't have the authority to basically control what Treasury does. That's not their area. So again, now incorporating what Treasury has talked about doing, we now have an updated, the end of 280 Cap E for medical marijuana, right? Same thing. We're going to talk about all the regulatory shifts and then the federal tax impacts. And again, we have our nice little thing. It'll be in the slides. It's on the screen right now too. So again, you can download the slides and this will be in it. Or what you can do is I accidentally, for those of you watching the slides, accidentally brought up my menu bar on a Mac. So you got to see that. Isn't that fun? Anyway, but, we're going to essentially be aware of what this is and how it works. And keep your eyes open for what happens with regard to the non-medical marijuana. We may revisit this before the end of the year. I'll just say I wouldn't be surprised if we're back talking about the second part of this. Okay, our next development, we have a new guidance regarding excise tax refunds. On April 30th, the IRS and Treasury issued temporary regulations under TD 10047, identical cross-reference proposed regulations that we're going to now analyze under the new dyed fuel excise tax refund regulations under 6435 that were made necessary by changes in the One Big Beautiful Bill Act, right? So again, these proposed and temporary regulations were issued on April 30th of this year. The IRS also issued news release IR 2026-59 to announce the framework for the recovery payments. So we'll talk about all of that stuff. Okay, let's talk about the background of these regulations and why the IRS took the unusual step of bypassing the standard notice and comment procedures to issue immediately effective temporary regs. The One Big Beautiful Bill Act created IRC Section 6435 to allow taxpayers to recover the IRC Section 4081 excise taxes paid on diesel fuel or kerosene that is later deemed exempt. However, the legislation was drafted with quite a bit of ambiguity. It did not include language deeming the payment of a refund of an overpayment, and provided no specific appropriation to fund the payments. So we have this thing, but no clear way to pay it. So the IRS figures they've got to deal with that. Bound by Title 31, United States Code 1324B1, which limits general fund disbursements to overpayments defined under 6402, the IRS determined it only has legal authority to pay these claims directly to the actual person who paid the original tax. So if you're claiming that indirectly you paid this tax, you cannot file this refund claim. Right? Immediate guidance was deemed critical to prevent public harm and give taxpayer clarity on how to structure their business arrangements, making sure who's going to be claiming this. To implement this, the new regulations add, for now, temporary regulation, Section 48.6435-1T, and proposed regulations, again, Section 48.6431-1, which would take the place of the temporary once they're made final. First, eligible dyed fuel is defined as diesel fuel or kerosene on which the 4801 tax was previously paid and not already credited or refunded, and which is exempt from taxation under IRC Section 4082A. To bypass the appropriation limits that we just discussed, a Section 6435 refund is strictly defined as a refund of an overpayment without interest under Section 6402. Consequently, the identity of the claimant is heavily restricted. The IRS emphasizes that payments will only be made to the taxpayer who actually paid the prior fuel excise tax directly to the IRS. Okay, indirect payments do not count. I don't care that you really paid it, that you were really the one that ended up having to pay it, and it just went through the other party. The other party's got to apply for the refund. IRS says they have no option under the laws that exist unless Congress were to fix this. Will let's get Congress to fix it? Who knows? So what are the conditions and how do you do this reporting? Right? So we have a strict conditions and reporting framework that the IRS has implemented. Under Regulation 48-6435-1TD, claims are conditioned on 4 requirements. Taxpayer must prove the tax was imposed, that they were actually liable for and paid the tax without prior refund. They remove the fuel from an authorized and approved terminal under Section 4082A, and that they meet the specific reporting mandates. To prevent duplicate claims, Treasury Regulation 6435-1TE requires a highly tailored 6435 taxpayers report. This report includes a mandatory declaration of exclusivity where the taxpayer must swear they have not received and will not claim alternative credits or refunds for the tax. Furthermore, the report acts as a revocation clause, explicitly identifying and legally removing any prior first taxpayer report previously filed under Section 48.4081-7C for that specific fuel. The issues. Now, what about the actual filing mechanics to ask for your refund? For Treasury Regulation 6435-1TF1, taxpayers must submit their claim on Form 8849, Claim for Refund of Excise Taxes, and must include a newly completed Schedule 5 to that form. Practitioners must be aware of the exclusivity trap. A 6435 claim absolutely cannot be combined on the same Form 8849 with any other non-6435 claims. Don't have other things on the one that's going for this claim. These claims can be filed anytime before the statute of limitations for overpayment expires. Regarding effective dates, these regulations apply retroactively to eligible removals occurring on or after September 1st, 2025. Finally, note the sunset provisions. The temporary regulations will automatically expire on May 1st, 2029, or sooner if a statutory change appropriate funds for paying claims to someone other than direct taxpayer. And honestly, yes, eventually, the final regs would replace it. But because temporary regs have a restricted lifespan, right? We get them for essentially only a few years. So we have to go ahead and do it. Since we did these, that we got published in the Federal Register on May 1st of 2029 or 2026, 3 years from there, they have to expire. So that's our issue. Again, we have another, infographic here, recovering excise tax on previously taxed dyed fuel, which is a guide to the issue. It has a top part that talks about your eligibility and core requirements to get this. And then your filing and reporting process is the bottom half of it. So again, as I said, they're available in the slide deck. They're on the screen if you're watching the video. So I suppose you get pause right now if you really want to study it. But downloading the slides is probably the simpler way to get it, something you can actually print out and use otherwise. Now our final major topic. This is an executive order that was entitled Promoting Retirement Savings Access for American Workers by Established TrumpIRA.gov. It was signed on April 30th, 2026. Our title for this section, not surprisingly, is Executive Order on Retirement Savings and its Interactions with IRC Section 6433. That's the savers match. That's key. This directly addresses a coverage gap in retirement system. It's meant to help cover people who don't have access to employer-provided retirement programs. And it does this by utilizing the Federal Savers Match enacted under the Secure 2.0 Act to bridge gaps in retirement planning, specifically for self-employed and gig economy clients, are the big ones they're looking at here. How are we going to get them in there? Okay. Now, this is something that's, the Savers Credit's been around before. And you've been able to claim these, but there's never been like a centralized place you could go that would point these people to, to basically to custodians who will accept the saver's credit. That's going to be key, and we'll go through that process. So the executive action targets tens of millions of workers, particularly gig economy workers, part-time employees, independent contractors, and the self-employed who face unnecessary barriers because they lack access to traditional employer-sponsored retirement plans. They don't have a 401k or any other type of employer-sponsored retirement plan that benefits them. To facilitate this, the Treasury Secretary has mandated to launch a centralized information platform. It will be named TrumpIRA.gov. Yeah. You name things, right? He names them after himself. He always has. So it's there. Do not react to that one way or the other, please. Please try to evaluate things like this based on how they function and whether it's a good deal for a client, not based upon your feelings for a particular politician, because I have a feeling we're going to see a lot more of these going forward now that we've kind of established a precedent here. In fact, knowing the way that these things tend to work, we'll probably see the next president just simply cross Trump off the account, off the website, and call it whatever their name is. Because why not? So this website is supposed to be up and running by January 1st of 27. The government is posing a strict cost control on a financial institution that wants IRA listed on the site. Participating IRAs must limit their overall net expense ratios to a maximum of 0.15% and cannot impose any minimum contribution or balance requirements. Additionally, these institutions must legally agree to accept the Federal Savers Match Department deposits under 6433E2C. Now, that's a number of restrictions that I suspect a lot of custodians are going to be like, what do you mean no minimum balance requirements? What do you mean? Basically my cost ratios have to be 0.15. But it's kind of based on the Trump, basically the Trump account and their level. So you can see where they're getting this from. Again, you don't have to have an account like this to get basically the Treasury match. But you have to have a custodian that'll accept it. That may not be quite as easy to find. Now, how does this platform interact with the Internal Revenue Code? Section 6433 effectively transformed traditional non-refundable savers credit into a direct matching contribution from the federal government. That was a change in the One Big Beautiful Bill Act and the Secure 2.0 Act. Instead of offsetting tax liabilities on a return, 6433, I guess it was Secure 2.0 that did this one, not One Big Beautiful Bill. 6433A2 Cap A dictates that the match is paid by the Secretary directly into that individual's retirement savings vehicle. That's why we need custodians to accept the deposit. There is, however, a de minimis exception to this direct deposit rule under 6433A2B. If the calculated matching contribution is greater than zero but less than $100, the direct deposit is skipped and it reverts back to being treated as a standard personal tax credit in his return. In order for an IRA to be listed on a new federal tax platform, the financial institution must be integrated and agree to accept these direct government match deposits. Right? The idea is to provide a one-stop shop for qualifying custodians who are going to agree to these terms, theoretically giving these savers access to a low-cost IRA account. I don't think I've heard anybody disagree with the concept. Grumbling about the naming, sure. Disagreeing with the concept, I really haven't heard anybody disagree with it. Okay. Now, we're talking about the specific math and phase-out ranges next that regard this, how much a match can receive. Maximum match is calculated using an Apple percentage of 50% as defined in 6433B1. Because 6433A1 caps maximal qualified savings contributions at $2,000, the maximizing this benefit will yield a maximum 1,000 match. So bottom line, you can get, if you qualify before phase out, before you start phasing out, you could qualify for up to $1,000, but to get $1,000, you had to put $2,000 in the account. This is not a blanket benefit, though. The match is subject to a strict phase out based on a taxpayer's modified adjusted gross income, which is frankly relatively low. Under IRC Section 6433B3A, for taxpayer filing joint return or as surviving spouses, the dollar amounts where the phase-outs begin is $41,000. And the match fully depletes over a $30,000 phase-out range. For other filing statuses, the code applies a fractional approach to these joint returns. For head of household, The law dictates a dollar amount, and the phase-out shall be exactly 3/4 of joint amounts. And for single filers, it'll be 1/2. That's going to be your background. Now, how is this contribution legally treated, and what happens if a taxpayer tends to withdraw it prematurely? A key consideration when calculating a client's contribution limits is that Section 6433F2B specifies federal matching contributions shall not be taken into account for any applicable contribution limits. The IRA, the plan, a 403B, basically it doesn't count as contribution. That means matching funds completely bypass and do not consume the taxpayer's annual contribution limits, including for an IRA. Furthermore, under Section 6433F5A, the match is entirely protected from government collections or offsets under IRC Section 6402. Now, to prevent taxpayers simply depositing the funds, and as soon as they show up, withdrawing them and then going and doing whatever they want, after they get the match, the code contains a strict clawback provision. If you take a specified early withdrawal from the matched account, IRC Section 6433F6A dictates a direct income tax increase under Chapter 1 to recapture that excess. Now, there's a mitigation clause under 6433F6CI. The recapture tax can be reduced, but not below zero if the individual elects to roll the early distribution back into an Apple retirement savings vehicle before the prescribed deadline. So make sure you go through all of those rules, right? Because clients can't just say, "Oh, I'll do it," and then go right in, pull the $1,000 out and my $2,000, right back out, and I'll have extra $1,000 in hand. And I'll pay the tax on the $1,000 because I'm low income. I don't have really any significant tax liability, so I'd do that. And they're saying, "No, you're going to repay the whole thing." That could be a problem. As again, our final infographic is up there. It shows you about who's this designed for. Obviously, your high-income taxpayers are not the people this is designed for, right? It's meant really for those who can get the match. That's the main advantage. Yes, it would be a source of low dollar, low cost IRA custodians, but you can find those on your own, right? And you may find you're going to get better investment options if you're not in the group that agrees to all these terms. That's just going to be one of those things, right? And again, it's supposed to launch by January 1st of next year. So in theory, it could be in place in time to take contributions for 26 tax year. Now, to be honest, one real problem for people that can qualify for the credit is actually having $2,000 to put into the account. That is a real world issue that if you work with people with that income level, you're probably going to realize pretty quickly. They got to qualify for the IRA contribution and they got to have $2,000 extra. And that could be a problem. They may, if they're going to do it, they probably need to start doing small amounts during the year. The problem is we don't know where to set those up yet. And so we have this problem right now. So you'd have to do your own work, the whole legwork you're supposed to get rid of. You'd have to do this year to get this benefit. So be aware of it. Okay. And then we talk about, the match and how it works and all of that stuff. All part of here on, basically the infographic that you'll get if you download, or it's on your screen right now if you're watching the video. So note, that is a planning opportunity for lower income individuals. So I'm sure there's some people that watch this that may be involved in Vita clinics and things like that. You'll probably be talking about these things because a lot of those taxpayers are going to be in a position to potentially take advantage if they have a retirement contribution. You can talk about that. So keep that in mind. Otherwise, this has been the Current Federal Tax Developments for May the 6th of 2026. Current Federal Tax Developments, as always, are brought to you by your State Society of CPAs. If you have any questions, my email address is on this final slide, edzollers@currentfederaltaxdevelopments.com. You can send an email to me there to ask questions, and I'll let you know if I know of any answers that we might have to get that done. I also do, as I mention every week, I'm members of a number of Connect sites for state CPA societies. That includes Arizona, New Jersey, Illinois, Minnesota, Idaho, Washington are the states that I'm actually looking at. So if you post a question, one of those, and I think I could help, let me know. I'm also following along on the AICPA's National Connect site. They redid that. Hint, you're not aware, I used to be in charge long, long ago of the AICPA's CompuServe Accountants Forum. I was the SysOp. Yes, weirdly, Long story, but I knew how to run CompuServe forums before the AICPA showed up there. They discovered I was a member, and I started looking in there, and they also discovered I had a free paid account paid for by the group that was running the forum that I was doing work for. At that point, it was a group that wasn't really part of a software company that we were supporting the product for, but was related to it and had kind of a weird relationship with the company that we did. But I had that; and it was paid for by that group, so that was good news. And the ICPA saw that there's no budget impact, and we get somebody else take this headache off our hands. So while that existed, I was there. So this is kind of returning to that. And it is, if you haven't been there, the AICPA Connect site, if you're a member, the AICPA Connect site is very much like the State Society Connect site. So if you've ever looked at those, you can see the AICPA version. Otherwise, thank you for being here this week. We are going to watch to see what comes out next week, because again, we had very few court and almost no court cases this week of any significance. So we'll see if we have something more from the courts next week. But otherwise, we're going to be back here, plan to be back here for the May 11th version of current federal tax developments. And since this is the May 4th edition, I guess this is Happy Star Wars Day, if you're listening to it on May 4th. And we'll see you next week.